Hello, and welcome everyone to this information session on recent changes to the Central Liquidity Facility, also known as the CLF, made in response to the recent pandemic. We hope to answer some of your questions regarding how the CLF works and what recent changes to the facility may mean for your credit union should you be an existing or potentially new member. Before we begin, I have a few tips to help you get the most out of today's webcast. First, make sure to turn up the volume on your computer or external speakers so you can hear us, and make sure that you can see the slides clearly. Make sure your screen resolution is set to 1024 × 768 or higher. If you have trouble seeing a slide, you can click the Enlarge Slides button at the bottom of the console. At the conclusion of the presentation, we will tell you how to obtain more information about the CLF and how to become a member. We also welcome your input and questions and urge you to email the CLF at any time. You'll find our contact information at the end of this presentation. Your questions are helpful to us, and we will use your feedback to update frequently asked questions for publication on the CLF's homepage of the ncua.gov website. We will begin today's session with a special message from NCUA Chairman Rodney Hood.
Hello everyone and welcome. This is NCUA Chairman Rodney Hood. Thank you for joining us for this presentation on recent changes to the Central Liquidity Facility. The COVID-19 emergency represents a dual challenge. First and most immediately, we have the necessary public health response to flatten the curve. Second, we must move swiftly and wisely to mitigate the pandemic's impact on the job market, access to capital, and economic growth. Since the COVID-19 emergency began, the NCUA has taken steps to protect our staff's safety and execute our core mission as effectively and efficiently as possible in our current remote posture. NCUA examiners and staff stand ready to work with the credit unions as they respond to these unusual and challenging circumstances. If your credit union needs to make a policy adjustment to meet the needs of borrowers facing financial stress, we want to give you the flexibility you need. If your credit union deems it prudent to ease loan terms to help a member through this difficult time, we'll try to work with you. In its role as regulator, the National Credit Union Administration has responded decisively to the needs of the federally insured credit unions we oversee. Our top priority, after ensuring the safety and well-being of our agency's workforce, is to ensure that the nation's credit unions can continue to respond to the financial needs of their members in this difficult and uncertain environment. One way we're doing this is through the Central Liquidity Facility, a mixed ownership government corporation that exists within the NCUA and serves as the liquidity lender to credit unions experiencing unusual or unexpected liquidity shortfalls. I worked diligently with Congress to ensure key changes to the CLF were included in the Coronavirus Aid, Relief, and Economic Security Act, known as CARES, which was signed into law on March 27th. The NCUA Board also took several actions in April to improve the CLF's flexibility and strength. These actions included eliminating the 6-month waiting period for a new CLF member to receive a loan and easing the period for how long a member must wait to receive back their paid-in capital if they choose to terminate their CLF membership. We believe these measures and those in the CARES Act will encourage more credit unions like yours to join the CLF, further reinforcing its borrowing power. Liquidity, like capital, is indeed a pillar of strength upon which our system rests. This is true during any economic or financial disruption, and we all know how important it is for credit unions to continually have unfettered access to contingency funding if and when the need arises. The CLF is a proven solution for individual credit unions and for helping to stabilize liquidity throughout the entire credit union system. I am pleased to report that as of today, that all 11 corporate credit unions have joined the CLF as agent members. As agent members, the corporate credit unions have purchased the CLF capital stock for their member credit unions with assets less than $250 million. Because of this, More than 3,700 credit unions are now eligible to apply for a loan from the CLF, and it has increased the CLF's borrowing capacity by over $13 billion. In today's presentation, we are highlighting these important enhancements. I've invited Owen Cole, the president of the CLF, to walk you through these in more detail. He'll talk in overall terms about how the facility works, what these recent changes may mean for your credit union, and how the NCUA views the role of the CLF within the broader context of a credit union's liquidity risk management program. If you are not currently a member of the CLF or a member of a corporate credit union, I hope you will consider joining the CLF to augment your existing liquidity and contingency funding plans. CLF membership is entirely voluntary, but there is strength in numbers. And by working together in the cooperative spirit in which our industry was founded, and by bringing more credit unions into the CLF fold, we will bolster the system's potential access to liquidity in the event it should be needed in the future. Before I hand things over to Owen Cole, I want to thank you and your hardworking staffs for your continued efforts to meet the needs of your member owners during this national challenge. Your efforts are truly in the best tradition of people helping people that has guided the credit union industry for nearly a century. While I believe the credit union community will remain safe and sound, it is difficult at this time to predict how this crisis will unfold. These CLF measures will help ensure sufficient liquidity is available until we have a clearer picture of the economic impact of the COVID-19 crisis. By working together in the cooperative spirit on which the industry was founded, the credit union community can assist one another in ensuring the system has adequate liquidity and thus maintain the health of the credit union system as we prepare for the economic recovery to come. Thank you all for joining us today. Now I would like to turn the floor over to Mr. Owen Cole, President of the CLF.
Thank you, Chairman Hood, for that kind introduction. Welcome, everyone. I'm Owen Cole, and I'm the President of the CLF, as well as an Associate Director in the NCUA Office of Examination and Insurance. As the Chairman stated, the NCUA has made some significant and important changes to the CLF to help credit unions navigate the current pandemic, commonly known as COVID-19. I'll start with a little bit of a primer so everyone has a good understanding of what the Central Liquidity Facility is and how it works. The fact that the CLF is a backup resource that is sparingly used means many stakeholders aren't familiar with the details of the facility, and we trust this information will be a helpful refresher. I'll also cover the changes to the CLF that have been made as a result of the CARES Act, and conclude with a discussion on how these changes align with the NCUA's long-standing supervisory expectations for liquidity risk management by credit unions. You may be familiar with the benefits CLF membership credit unions. The NCUA issued guidance in April on the CLF that included a reminder of key benefits and how they help members handle a disruptive event like the COVID-19 pandemic. Some of the key benefits that result from increasing the levels of membership in CLF include the following. Having more liquidity in a time of elevated uncertainty or crisis is always preferred. By increasing CLF's borrowing capacity, it increases amounts it can borrow from the Treasury, which is an external source to the system. Treasuries are backed by full faith and credit of the U.S. government, making the source of CLF funding highly dependable. CLF liquidity helps individual members as well as the broader system as a whole. One way it helps the system is that CLF can lend to the Share Insurance Fund, as it did in the last crisis. Because CLF can borrow a multiple of its capital base, a small stock purchase amount translates to a significant corresponding boost in its lending capacity. I'll now cover a little CLF history. The Central Liquidity Facility was first established by Congress when it passed the National Credit Union Central Liquidity Facility Act in 1978 in Public Law 95-630. That's the same law that restructured the NCUA to be run by a 3-member board and established the FFIEC, among numerous other things. The CLF became operational in 1979 after the NCUA issued its initial final CLF rule, Part 725, in August of that year. Congress's goal in creating the CLF was to establish a source of funds for individual credit unions that needed liquidity at a time when they did not have access to the Fed's discount window facility. Thus, to create parity with banks and provide credit unions a more reliable source of backup liquidity, Congress created the CLF using the Federal Reserve System's discount window as a model. The CLF is owned by its member credit unions, managed by the NCUA Board, and is financially self-supporting. It covers its operating costs through earnings on its investments in U.S. Treasuries. Like the Fed's discount window, CLF is a federal contingent liquidity source. While the Fed, as the nation's central bank, creates credit as needed, CLF obtains its funding from the U.S. Treasury. Today, most credit unions have access to both the Fed discount window and CLF membership, a choice that is theirs to make. The CLF has proven to be an important backup source of liquidity for both federal and state chartered credit unions throughout its history. Federal and state chartered credit unions, even those that are privately insured, can join the CLF directly by submitting an application for membership and subscribing to capital stock of the CLF as set forth in NCUA Regulation 725.3. These members are called regular members. Corporate credit unions can also join the CLF on behalf of a group of their natural person credit union members. Corporate credit union members of the CLF are called agent members. They serve as a conduit between the CLF and their member natural person credit unions that are in their approved agent group. Those groups are approved by the NCUA when the agent joins the CLF. We'll talk about some recent changes to CLF membership later. Let's look more closely at the requirement for CLF member credit unions to purchase capital stock. This stock provides capital to support loans, and it also allows the CLF to support itself financially. The amount of capital stock an applicant credit union must purchase is defined in 12 U.S.C. 1795C of the Federal Credit Union Act, and also in 12 CFR 725.2 of the NCUA's regulations. It's calculated as a percentage of the credit union's paid-in and unimpaired capital and surplus. You may ask the question, is an investment in CLF capital stock safe? Yes, it is a highly safe investment. The capital stock proceeds are invested directly with the U.S. Treasury and maintained in a portfolio of Treasury securities at all times. By statute, the NCUA is required to pay members the face amount of their capital stock investment, less any amounts they may owe the facility when a credit union terminates its membership. Additionally, the CLF works closely with the NCUA Share Insurance Fund, which has the authority to grant guarantees and is backed by the full faith and credit of the U.S. government. Once a credit union has calculated the amount of CLF capital stock it must subscribe to, it will pay in half the requirement to CLF and hold the other half on call at the discretion of the CLF on its balance sheet in the form of liquid assets. CLF staff is ready and available to assist a credit union that may require assistance with this calculation. Once membership is in place, CLF members receive a quarterly dividend on the paid-in portion of their capital stock. The dividend rate is administered as an ability to pay commitment. As a general rule, the CLF seeks to pay out all surplus net income. The CLF has paid continuous quarterly dividends since it was established in 1979. By definition, the FCU Act specifies 3 different kinds of liquidity needs for which a CLF advance can be made to meet those needs. For short-term needs, it may apply for short-term adjustment credits. These advances are usually made for periods up to 90 days, but can be made for longer periods. Credit unions that face seasonal liquidity needs may apply for a seasonal credit up to 270 days. For liquidity needs that last longer, a credit union may apply for a protracted adjustment credit. The CLF rarely grants these loans. When it does, it makes the decision based on the unique circumstances of an institution likely facing significant liquidity challenges. Generally, liquidity need loans fall into the short-term category and aren't expected to be renewed at maturity because the CLF anticipates that a borrowing credit union will resume access to its primary market sources as soon as practicable. While the vast majority of CLF loans have been made for short periods, having the additional loan categories gives the CLF flexibility to tailor liquidity assistance to unique circumstances when warranted. Regardless of the type, all loans are fully secured by a first priority security interest in assets of the borrowing credit union, and a member must meet minimum creditworthiness criteria. The CLF makes loans for liquidity. However, it does not lend insolvency. In the past, the NCUA Board has been prohibited from approving loan requests that were intended to expand a credit union's portfolio. We'll talk about how this has changed temporarily as a result of the CARES Act later. So that concludes the general background on the CLF. Now I'm going to talk about the importance of the changes to the CLF made by the CARES Act and the NCUA Board in response to the COVID-19 pandemic. I want to point out that the changes I'm discussing include both legislative changes and regulatory changes. Legislative changes are those made by Congress through the Coronavirus Aid, Relief, and Economic Security Act, which was signed into law on March 27th. You may be more familiar with this as the CARES Act. The legislative changes are temporary, and they sunset on December 31st of this year. The NCUA Board made additional regulatory changes to support and enhance changes implemented by the CARES Act. The Board did this when it approved an interim final rule to enhance Part 725 of the NCUA's regulations. Some of these changes will be temporary based on the sunset provisions in the CARES Act, and some will be permanent. The legislative and regulatory changes are described in NCUA Letter to Credit Unions 20-CU-08, entitled Enhancements to Central Liquidity Facility Membership and Borrowing Authority. You can find this and all the other messages associated with the COVID-19 pandemic on the ncua.gov website. I'll go through the changes now, starting with the legislative changes made through the CARES Act. Remember, these changes will end on December 31st, 2020. Overall, the CARES Act introduced 4 important changes to the CLF. The first has to do with the CLF's borrowing capacity. Until the CARES Act, the CLF's power to borrow funds was limited to 12 times its total subscribed capital stock and retained earnings. That is, not more than 12 times its total capital. The CARES Act has temporarily changed the CLF's maximum borrowing amount to 16 times total capital. This means that $1 of paid-in capital translates to an incremental $32 in additional borrowing capacity for the CLF. And remember, members only submit half of their subscribed capital amount, but the CLF's borrowing authority is based on the total subscribed amount. This leverage feature is what makes CLF membership so powerful. Added capital gives it exponential borrowing authority. A lot of people ask how the CLF's maximum borrowing authority, a number that gets quoted often, is calculated. Here on this slide, we've broken the computation down so you can see the bottom line using our April 2020 financials. Remember, CLF member credit unions only pay in 1/2 of the subscribed capital amount. The rest stays on call and doesn't show up on the CLF's balance sheet. This slide shows all the capital components. To get a total capital number, we add the paid-in capital amount from line A to the on-call capital from line B and add that total to CLF's total retained earnings from line F. The sum is shown on line G. That's what we multiply by the new leverage factor of 16 to get the CLF's total borrowing capacity shown on line I. Notice that our previous borrowing authority in line H would have been only $7.9 billion under the old leverage multiplier of 12, but jumps to $10.5 billion with the new multiplier of 16. That's an increase of 1/3. The second change the CARES Act made has to do with the requirements for agent members, corporate credit union members, to purchase CLF capital stock. The CARES Act relaxed the requirement for agent members to purchase capital stock for all of its member credit unions, and now allows these members to purchase capital stock for a select subset of the credit unions they serve. This can significantly reduce the cost associated with agent membership. In March and April of this year, the NCUA and all 11 corporate credit unions worked together to establish a target asset threshold under which the corporate credit unions would buy membership capital stock for all their member natural person credit unions that aren't already regular members of the CLF. The total asset threshold is $250 million. This means that all credit unions less than this amount are covered by their respective corporate credit unions' CLF agent membership. This allows the agent network to essentially be applied across the system in a uniform and consistent way for most small credit unions. There are some credit unions below the $250 million asset threshold which aren't CLF regular members and don't belong to a corporate credit union. The NCUA will send information to these credit unions about how they can gain access to CLF if they so choose. And remember, you can always get all the information you need to learn about membership and how to apply on the ncua.gov website. The CARES Act also temporarily changed the definition of liquidity needs to include the liquidity needs of corporate credit unions. This change, the third of 4, allows corporate credit unions to borrow from the CLF to meet their own liquidity needs, an important federal contingent liquidity source for these credit unions that will remain in effect until December 31st. Lastly, the CARES Act provides more clarity about the purposes for which the NCUA Board can approve liquidity need requests by removing the phrase, quote, "The board shall not approve an application for credit, the intent of which is to expand credit union portfolios," end quote. The NCUA Board now has more flexibility and discretion to approve applications for CLF members that have made a reasonable effort to first use a primary source of funding. This change increases the transparency and efficiency of the loan approval process by removing doubt about whether a credit union's portfolio may expand if it borrows from the CLF to meet its liquidity needs, and ultimately lets more credit unions qualify for a CLF loan. I talk more about how CLF borrowing fits into a credit union's contingency funding plans when I'll talk about the supervisory expectations a little later in this presentation. Speaking of the NCUA Board, it's time to move on to the regulatory changes the Board passed on April 13th. Let's look at the 4 changes the Board made to make it easier for credit unions to join the CLF and to ease regulatory burden. To make these changes take effect at the earliest opportunity, the Board took action between scheduled Board meetings to handle this by notation vote. By going straight to an interim final rule, they accelerated the implementation date, which took effect when the rule was published in the Federal Register on April 29th. This underscores the expedience with which the Board has acted to get these temporary authorities in place quickly. First, the Board eliminated the 6-month waiting period for a new CLF member to receive a loan. Now, regular and agent members of the CLF can borrow as soon as they complete the new member documents and pay in their required stock subscription. The Board felt it was important that CLF members be eligible for liquidity assistance at the earliest opportunity and has made this change permanent. The second change the Board made is temporary. Between now and December 31st this year, credit unions can more easily terminate their CLF membership and have their CLF capital stock returned. Both new and existing CLF members can terminate their membership, and they don't wait longer than 6 months for their withdrawal to take effect. The rule allows the CLF member to receive its capital stock amount back within 6 months or by the end of this year, whichever is sooner. This means that the notice period will get even shorter once we are less than 6 months from December 31st. Between December 31st this year and December 31st, 2021, CLF members can terminate immediately once they have provided the Board written notice. After December 31st, 2021, the standard termination timeline of 6 or 24 months will go back into effect. This change was made to allow credit unions to join the CLF during the pandemic period without worrying about being locked into membership for longer periods once the pandemic ends. Don't forget, the more members the CLF has, the higher its borrowing capacity is, giving the NCUA more ability to provide liquidity assistance to credit unions in need and to the Share Insurance Fund if a more systemic need for liquidity becomes evident. Another permanent change the board made was to ease certain collateral requirements for CLF loans. Previously, Section 725.19 required each CLF loan be secured by a first priority security interest in collateral of the credit union with a net book value at least equal to 110% of all amounts due. This meant that the haircut for collateral was the same, regardless of the asset type or its risk. Under the new rule, the amount of collateral will be determined from the CLF's collateral margins table, which is published on the NCUA's website. The required collateral percentages vary based on different types of assets, and in some cases, less than 110% will be required. Depending on what kind of collateral is pledged, a borrower may find its collateral requirements are eased somewhat if the amount required is less than 110%. In other cases, the requirement can be greater, and that's simply a function of the risk. The last regulatory change the board made aligns with the CARES Act change that allows agent members to borrow from the CLF for their own liquidity needs. Any agent member that purchases a CLF capital stock subscription on its own account will qualify to borrow from the CLF to meet its own needs through December 31st, 2020. These loans will be subject to the same creditworthiness and liquidity need criteria as for all other member loans. To establish CLF membership to meet its own liquidity needs, a corporate credit union will apply using a regular member application and buy paid-in capital based on its own balance sheet. In this way, a corporate can be both an agent and a direct member of the facility, and either role is voluntary on its part. Now, I'm going to cover some supervisory expectations that we recently shared with NCUA staff. We believe these will be helpful to consider in discussions on liquidity risk management with credit unions. I'll discuss the role the CLF might play in a credit union's contingency plans and how the NCUA views access to this federal contingent liquidity source, especially during the current pandemic period. I'll begin with some key points that are always relevant when examiners and credit unions discuss the CLF. Most important to remember is that membership is not an explicit regulatory requirement. Rather, it's a component of sound practice. As a federal regulator, the NCUA is in a unique position to also administer this specially created mixed ownership government corporation that acts as a backup source of liquidity for credit unions. We reiterate to NCUA staff that membership in the CLF is not required and that the NCUA may not assign an adverse examination or supervisory rating to a credit union because they choose not to join. CLF membership is completely voluntary, and the decision whether to join the CLF is a credit union's business decision to make, not the NCUA's. We do, however, encourage our staff to understand and point out the benefits of CLF membership and how it has helped the credit union industry overcome difficult times in the past. We strive to ensure our examiners are fully informed so they can provide current information about the CLF when discussing issues that may have a relevant bearing on a credit union's liquidity and contingency funding plans. We expect that liquidity discussions between examiners and credit unions may become more likely if pressures on portfolios and liquidity positions become elevated. We're not making that prediction, but we want to be proactive and think about possible contingencies to help mitigate any undue risks. Importantly, this pandemic may cause unusual and protracted liquidity disruptions for individual credit unions or even disruptions for the larger system as a whole. We don't have any way of knowing exactly how the economic and financial impacts of this pandemic are going to impact credit union portfolios. We do know that current market projections for the level of unemployment and the corresponding impact on loan delinquencies is a cause for concern. The recent actions taken to bolster the authorities of the CLF are precautionary measures meant to help NCUA strengthen its position to be responsive and to move swiftly and forcefully should a need arise. We do not know the timing of when heightened liquidity pressures may emerge, nor do we know how long such pressures might remain. Our efforts to date are designed to get out in front of possible liquidity issues and make the system more resilient. What we have learned from past financial crises is that access to liquidity is crucial to maintain normal operations and secure the time necessary to deal with problems as they emerge, and to endure through periods of uncertainty and volatility that can exacerbate financial distress. For example, in the last financial crisis, we found that access to federal sources of contingent liquidity were the most reliable, and they proved crucial to our ability to restore the credit union system back to a strong and stable footing. In that crisis, CLF was able to borrow from the U.S. Treasury, which made our access to liquidity highly reliable when many liquidity markets had shut down. You'll hear NCUA officials figuratively refer to CLF membership as a kind of liquidity insurance. Many credit unions that join the CLF maintain a view that borrowing is an unlikely occurrence, but they want to have access in place if and when an unexpected or unplanned need arises. In this way, it helps them insure against an unforeseen serious liquidity event. It provides them a very stable backup funding plan that is from a federal source. And as I have already mentioned, in times of crisis, a federal source, like the Federal Reserve discount window or the CLF, may be the most predictable and reliable form of liquidity a credit union can obtain. Again, CLF provided liquidity was absolutely instrumental in helping the NCUA and the credit union system overcome the last financial crisis more than 10 years ago. This diagram may look familiar to you. We developed it back in 2012 when the NCUA was drafting the Liquidity and Contingency Funding Rule, Section 741.12. They say a picture's worth 1,000 words, and we hope this one conveys helpful context for where the CLF fits into the liquidity risk management framework. The NCUA likes to describe a credit union's liquidity plan as comprised of three key elements. 1, the balance sheet. 2, access to primary sources of market funding. And 3, access to a federal contingent liquidity provider to back up the first two sources. We urge credit unions to hold a sufficient amount of available, high-quality liquid assets on the balance sheet at all times. We also urge credit unions to maintain a funding strategy that provides for diversified sources of funding, like, for example, those available from a corporate credit union, bank line of credit, or Federal Home Loan Bank advance. And finally, we urge credit unions, and we require those with more than $250 million in total assets, to establish access to a federal contingent liquidity source for unexpected emergencies. Notice the CLF is part of the third backup element and is expected to be used sparingly, only when a credit union finds that its balance sheet liquidity and market funding sources aren't available or are insufficient to meet its needs. We're not asking credit unions to consider membership in the CLF to substitute the facility in place of its primary sources. Rather, we're reminding credit unions that there's a time and a place for backup sources, and this pandemic could be one of those occasions. Bottom line, the CLF can play an important part in addressing forthcoming needs, and the board wants all stakeholders to fully understand how the temporary authorities recently given to the CLF accomplish these objectives. You can find lots of helpful information on the CLF page of the NCUA's website. You'll have links to our recent letter to credit unions, the renewed CLF operating circulars for regular and agent members, a how to join document that explains the key steps of signing up, and many other relevant resources. I encourage you to visit our website and check these out for yourselves. This concludes our discussion on the CLF. I hope this has been informative and helped you understand better how the CLF works, what the recent changes mean for credit union membership and borrowing, and how we as supervisors think about the role that CLF can play in a credit union's liquidity risk management framework. We'd like to hear from you. Please don't hesitate to contact the CLF directly at clfmail@ncua.gov if you have any questions. Thank you for listening, and we hope you stay safe and well during these difficult times.